Good afternoon. It's December 11th, 2020, 12:30 on the East Coast. And I want to talk about gold today. So this chart is very interesting because it shows that gold has this seasonal tendency to sort of put in a bottom towards the end of the year. Either it's usually the last 2 months of the year. And very often we see a year-end rally in the final weeks of a given calendar year. Of course, it doesn't always work, but it works more often than it doesn't. I do want to point out, though, that you can see that since 2013, this trend of a bottom at the end of the year and a tradable rally that lasts into January and February seems to hold true. In 2011 and 2012, it didn't really hold true. So this is something that we do want to make note of because we know that at the end of 2011, at the end of 2012, gold was topping and beginning to roll over, right? And then 2013 was a very, very bad year for gold. I mean, gold was essentially in a bear market from 2012 to 2018. It made a basically, in my mind, the bear market ended around late August of 2018. The bear market in gold came to an end. So that was a six plus year bear market in gold. And now we're we're ending year two of the bull market and moving into year three. So this chart is interesting. The daily sentiment index for gold right now is 33 as of yesterday's close. That's usually not where sentiment is at a top. That's usually where sentiment is during a pullback, maybe a tradable low or close to a tradable low. So yeah, talking about the different cycles, if we go back to this 2001 to 2011 bull market, year three in that bull market was around here, early 2004 or late 2003. I traded this during this time, and this period we're in right now, which honestly on the monthly chart is nothing more than a pullback. Obviously it feels a little different. The last few months, especially if you're trading every day, it feels like much more than a pullback in gold and precious metals miners, especially in the juniors. But this is nothing more than a pullback on the monthly time frame. It kind of feels like 2006 to me. Kind of feels like where things got really frothy in early August, kind of like they did in May of 2006, and we dropped pretty sharply for a couple months during the summer of 2006. May and June of 2006 were pretty bad months. So it kind of feels like that now, and to me it feels like we're coming to the end of this. And we might see things turn up again. It's also interesting to know that, this is support. I mean, the 1800 level, yeah, it's a round number. We use the round number. I've been talking about 1792, but 1800 is a big support level. It's a long-term support level. It was a very big upside level in 2011, 2012. Gold couldn't really hold above 1800 for very long back then. Now, gold has come back down to test that level from above, and it's holding above that level. That's a bullish sign in the long term, in my opinion. I do want to pull up this chart of the yearly flows. So 2009, gold had huge inflows, big inflows into gold. And that was actually a great time to be buying gold, because for the next 2.5 years, until it peaked at 1923 in August of 2011, you had the tailwinds at your back. I mean, gold was trading 800, 900, 950 an ounce in the first half of 2009. So you got more than a double over the next 2.5 years. So these inflows turned out to be pretty smart. And notice how there was a huge move into cash in 2008. So look at what's happening now. Cash is the biggest inflow of any sector or asset class in 2020. Isn't that hard to believe, considering what we're seeing in tech, which is the second largest? what we're seeing in the stock market, essentially, right? And gold is sort of number three, but it's a relatively small inflow relative to what was seen in 2009, okay, on the grand scheme of things. And you got to think, if people are overweight cash right now, you got to think to yourself, cash is the worst thing to have right now. We know the Fed is committed to creating inflation in 2021. They are committed at all costs, right? So if we know we're going to have inflation and we know interest rates are going to be very low, are going to be at zero, then cash is a guaranteed loser purchasing power. You know we're going to have higher than 1% or 1.5% or 2% inflation. They said that the Fed speakers even said we could overshoot to 2.5% inflation. So we know we're going to get to that eventually. Yet cash is giving you nothing. It's giving you zero return. So we have to think, where is this money going to be redeployed? All this cash is going to be redeployed in the first half of 21. It's starting now, right? And you got to think that gold is definitely a potential safe haven for that cash, especially because the cash gets no yield. Well, gold gets no yield, but gold can appreciate in value a hell of a lot more than cash can. Also, what about gold miners? I mean, so Newmont Mining is the biggest gold producer in the world. It's trading about 13, 14 times earnings right now, 13 and a half times earnings, paying almost a 2%, dividend yield. The chart, this is the weekly chart, looks very healthy to me. This looks like nothing more than a pause, a sideways consolidation over a few months, several months, within the context of a very strong bull trend, right? And Newmont is not expensive here at this price. Barrick, very similar. So it's sort of this rounding, topping process. We know that Warren Buffett may or may not have bought this, or at least his company bought it and sold it. But in the big picture, this is a pullback to an area of support. Nothing more, nothing less. It's just a pullback to an area of support after a major long-term bottom was put in place in 2018. Barrick is also not very expensive, trading about 14 times forward earnings. If the metals prices continue to appreciate, if we see gold above 2,000, you could have Barrick above $40 a share again. You could have Newmont above 75 or $80 a share very easily. Also, core mining. So this is really interesting. The last few months have been a very challenging time for the precious metal sector, especially the miners. And core is just sideways, a perfect bull flag pattern. I'm not up to date on the fundamentals here, but the technicals definitely have my eye. And this looks very bullish. Imagine if gold does break back above 1,900 or God forbid even 2,000 over the next couple of months, core can probably head well into double digits, $14 or $15 a share quite easily in my estimation. And again, so this is the Gold Bugs, index monthly chart. We hit an area of previous support from 2012 near 400. And we've pulled back to an area of big support around 300. It's nothing. The price action, if you got to keep your eye on the big picture, the monthly and weekly charts, the price action in gold, the mining, exchange traded funds, the mining indexes, and individual senior gold miners are completely normal, healthy price action on the longer term time frames. You gotta sometimes stop staring at every tick and zoom out to the bigger picture and take it all in. And if this, informs us at all, especially with the daily sentiment index down at 33, seasonality very bullish for gold and gold miners for the next 2 months. Like we are now in the bullish seasonal period to own gold and gold miners until mid-February. Have a great weekend, and I'll see you in the trading lab.